Let's talk about what happened in markets as a result of the CPI. The core number came in above estimates, caused a bit of a wobble for a moment as people thought, you know, are we going to get the rate cuts? And then people decided, well, yeah, we are. We're just not going to get 50, which maybe a minority of people have been expecting anyway. So are we unchanged as we were post-CPI?
I think there are two interesting things here. One is that while we generally expect 25 basis points, there's still a little bit of uncertainty. There shouldn't be at this stage. It should be very clear as 25 basis points. Now, I know I'm biased because I felt that for a long while, but the data does not justify more. The reason we're not 100% sure is because the most important person in this decision, Chair Jerome Powell, is the one who seems most inclined by 50 basis points. That said, I'd be very, 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 very surprised if they do 50 basis points next week, and I think the assumption will be 25 basis points. The other big takeaway is it's made retail sales more important. People are realizing that maybe the disinflationary trend has run its course. What they're wondering now is if inflation does get a little bit more perky, is it because the economy really is doing fine and could continue motoring? Or are we at risk of a slight bit of a stagflationary scenario? So I think retail sales will be really, really important next week. And I think it'll see a larger than normal reaction in stock markets in which way it kind of beats or misses.
Yeah. Mark, so 25 is good for stocks. Is that my takeaway from yesterday? Because there has been this narrative emerging over the last few days that 25 would signal that the Fed is behind the curve, and that is bad news for stocks. So we're back to 25 being good for stocks, 25 signals a soft landing. Because if you just take the next decision in isolation, that appears to be the case. The problem with that is that the market is still pricing in very aggressive rate cuts, the bond market at least, from here.
I think we're slightly backfitting the narrative to fit here. Look, at the basic level, rate cuts help stocks. But it's why we get rate cuts. And I think what's happening now is that people kind of going, hey, there's no reason to panic yet. Now, we've changed that narrative a little bit on an inflation print, which isn't pro-economy, which is why I know you're asking the question. It's a little bit confusing. We seem to prefer 25 basis points that is more about inflation rather than the economy's holding up. But I think that the general idea that the economy is going off a cliff was overblown, was a bit overdone. And therefore, rates is upside. And I think equities have upside. They had upside regardless anyway, just because we had got too down the recession path.
Mark, how does this show up in the dollar? 30 seconds here.
I think the dollar is going to stay super volatile over the coming few weeks because of that overpricing of recession, because of that overpricing of rate cuts, but the fact that the U.S. story is still kind of positive. I am in the minority, I think the minority, maybe I shouldn't be so confident that the U.S. election will probably be negative for the dollar either way, and even more so particularly under a Trump presidency. There'll be a knee-jerk positive reaction, but that reaction will not sustain at all because I think the undermining of the Fed and the fiscal situation is more problematic.